Hi, good morning. My name is Steve O'Hare. I'm a partner in a business called Pia First with Coleman. Ian has been on the webinars over the last couple of weeks. I've just got back from holiday, so I'm going to present to you today. First of all, I'll give you a little rundown about myself, my bio. I started in the futures market in 1987, and I started work on the Baltic Exchange. The Baltic Exchange at the time was well known for freight futures and commodity futures, notably wheat futures, potato futures, and grains and soybean. So that's where I was first introduced to commodity markets. And I'm going to present to you today. Let me just first of all, I'll give you a little cut this forecast out. I can hear myself. There we go. Yeah, so that was my first introduction, and I started there as a more like a runner and a board marker. So the traders would be trading the different commodities. I'd be writing the trades on the board and keeping the traders up to date with what was actually trading. This is slightly before screens were relied on so heavily. And I worked there, and then I got picked up by one of the firms as a blue button. Spoke to clients about trading the commodities, and it was like quite a thrown in at the deep end, and you had to sort of sink or swim. At the same time, financial futures was taking off, and the life market was a big market and just starting to grow. And this was around 87, 88, around the time of obviously one of the big crashes. And during my lunch times, I used to go over there, and we used to trade the bond arbitrage, which was trading T-notes or treasury bonds, and we used to get the figures early. The US markets weren't open when the figures came out, so all the figures were traded in the UK. And during the afternoon, all the trades that we did in the UK, we transferred over to the US markets. So that was the arbitrage we did. And again, that was my first introduction to financial markets. So I spent most of my career on the live floor. I had an affinity with the bond market, or at the time it was the German bond market, the Bund, which is now the Eurobund. And I went self-employed in 1995, traded my own account. And one of the big things for me at the time was there was always it is obviously a very competitive market, so we were always trying to sort of like find ways of making money through buying and selling at different prices, and you're competing against all the people around you in the pit. And these guys were only trading, they were in and out very quickly, short-term trades. There was no real medium, long-term traders in there. It was basically come in and try and make money during the day and go home with a flat book. So that's one thing you had to sort of like learn how to do that. It was a survival of the fittest, the quickest, and it was about trying to react to what was going on in the market, trying to take in all sorts of information. But information was very limited back then. You were surrounded by guys who were surrounded by phone brokers, and the phone brokers were firing in orders, and we were trying to take the small scraps in between whatever the other people on the other end of the phone were doing. So the bank traders, the hedge fund, the pension funds. So, that was how I learned to trade, basically. And one of the big things that I found was to try and get an edge if you could. And one of the edges that I believed at the time was understanding what I was actually trading. So I sort of like took time to read about the Bund, which a lot of people didn't. They just looked at the numbers, traded the numbers, and were happy with just trading numbers, not really interested in why they were trading the numbers or what they were doing, whether they were selling a price or buying a price. They didn't really care as long as they felt like they could make money out of it. And someone introduced me to levels, so support and resistance levels, and this was in the form of very basic pivot to the daily pivot levels. And these, when I looked back on charts then, which were again very basic compared to nowadays, I saw there was certain resistance or levels or support levels that seemed to sort of like make sense to hold, and prices would get there and they would find buying coming in from all the phone brokers, and the bigger traders seemed to be buying there. And then the following day after day, you saw a picture building up, and you saw certain levels would attract buyers and sellers. A lot of my friends who were just interested in just trading the numbers and not really caring what the price was, wouldn't think that the day before the low in the Bund was 13 or 14, and wouldn't think the next day, oh, maybe 13, 14 might hold again. They didn't come into the equation. But I started to look at this, and I started to sort of feed this information to them and say, look, this is a level, let's sort of like, you know, this is a good level to buy. If it breaks this level, then, you know, it could go lower. If it doesn't break this level, you should really try and hold on to it. And it seemed to work quite well. And one of the other things that I found in the market, obviously, which a lot of the day traders did really benefit from, was the noise level. So you could be sitting chatting with a friend, or standing in the pit chatting with a friend, and all of a sudden the noise would start to build up. The phone brokers would shout to their traders in the pit and say, oi, 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 get their attention and fire an order in. And all the noise, when the noise level built up at the same time all around you, you knew something was happening. So that was like an indication that there was news out, that, you know, we didn't have news screens, or you know, we had a board which showed the prices, but there was like very limited additional news. So you used to react to the noise levels, and you used to sort of like, you could understand the difference between the noise level of someone selling or the noise level of someone buying. And it always seemed to be the panic and the fear when people were selling outweighed everything. And that's when day traders or scalpers of the market would be able to make decent money. They could feed off people's emotions. So again, that gave me a big understanding of how markets work, and it is about the sentiment within the market. Way back then, we could rely on the noise levels. Now we're screen-based trading, we can't do that anymore. So we've got to find other forms of being able to analyze the market on a short-term basis. And so that's how my sort of like early career developed. And shortly after the Bund market went screen-based, I then myself took the decision to go screen-based trading and take myself away from the open outcry market and into the depths of screen-based trading. And I spent a very painful year doing that, and you know, and that was something which I thought, you know, how is this going to work? You know, it was really stepping into the unknown. But then I sort of, obviously, because of my affinity with numbers and what I developed on the floor, it wasn't just the noise levels I relied on, which a lot of traders did. It was also, I looked at the pivot levels, and I used them on a daily basis for a good year, and it was a real struggle to make money. But I sort of like, I maintained a bit of discipline. I didn't try too hard, and I sort of built myself up. And after that year, I then sort of found ways of trying to make money in by having the quickest systems to trade, the easiest to use, and try and sort of like, again, find these little ways of improving your chances in the market on making money. Consistency, obviously, and discipline were paramount. I had to be disciplined. You couldn't let positions run against you because your P&L or your account was was watched over by a lot of risk managers. So you had to be disciplined. And so, you know, over the years from then, for the next 10 years, I continued to trade, did quite well trading, and then moved on, and sort of the markets, obviously, as I was moving along, the markets were moving along, the markets changed, and you had to adapt to them, just like it adapted from the floor to the screens. I had to adapt in different phases of the market on the screen-based trading, because, you know, screen-based trading was here to stay, although many people fought against it for a long time. But anyway, so I spent a lot of time over the next 10 years looking at different trading systems, charting systems, and my knowledge of technical analysis and analysis of the markets had built, because I felt that was the only way to stay ahead. You had to understand what you were trading. You had to understand why the markets were reacting sometimes when news was coming out. Obviously, news services were improving and chart feeds were improving. So you had to try and digest as much information as possible to continue to make money in the markets. Now, one of the things that obviously we used and made our lives a bit easier, because when you're focused on screen, you looked at the trading screen and you're trading, you obviously need more tools. You need tools like a charting system, and when your eyes are focused on the market, you can use your ears, so you need squawk services, and you need all these things in your toolbox to give yourself the best chance of success. And these things obviously initially came at quite a high cost, and you had to be careful. You didn't want to spend too much on certain equipment, because you have an account to protect. You know, you want to build your sort of like your fund of money up, and you didn't want to be extravagant and go and pay for the biggest and best systems. Otherwise, you know, before you know it, you're sort of like, you're under pressure. Your account's dwindling because you've sort of spent £1,000, £1,500 just on a trading system each month, and you sort of then there's other people offering free trading systems, or they look free anyway. And then you realise there's a spread involved, and then you have to work out how many times am I trading a day? Does it work for me? So there's a lot of things that, you know, every trader goes through who trades for himself, and not every trader reacts the same way to different things. But I found what helped me was understanding what the psychology of the market is around you, what other traders are doing, and a good way of doing this was getting the same sort of information as them, or going on blogs, or talking to other traders, surrounding yourself by like-minded traders, maybe finding out what information all the day traders are using if you're still day trading, and understanding what the market, how the market is poised at any point of the day if you're still day trading, if you're still scalping, if you're still looking to take a few ticks. Then all of a sudden we came to the age of the algo and the HFT, high frequency trading systems, and they seem to replace the scalpers, the day traders on the real short time frames. You can't. It's very difficult to compete with them sort of systems nowadays. So then you've got to adapt again. You've got to look at maybe a slightly different time frame. But you've also got to make sure you're adapting something that suits you, and not every tool that I use will suit the people in front of me today, the people who are listening to me. They might have a slightly different mentality towards risk, reward, market feel sentiment. And, you know, so it's a case of, you know, one of my things that when we were teaching traders how to trade, it's a case of you've got to really find your inner trader, and you've got to try and develop that inner trader in yourself. And it doesn't matter how much information you throw at people. Sometimes people just haven't got the aptitude or the mentality to trade, to make a success of trading. And even if you throw the same information at a whole host of people will react to that information in different ways. So yeah, it's I don't want to sort of dwell too much on me, but I thought I'd give you a basic introduction of, you know, where I was, what I've gone through, and where I am today, which is a partner in a firm, Pia First. We supply day trade ideas to individual traders, hedge funds, banks, pension funds, whoever wants to wants that sort of tool in their toolbox. And I wanted, I've sort of like gone that extra step this year. I've become qualified in technical analysis after using it most of my trading career. So at least I can say, yeah, there's a certificate from the STA to show that I know a little bit about what I'm talking about. Maybe not as much as some people, or I'll leave it down to you to decide. But I want to try and make this webinar a little bit interactive, so that I will start to show you how I look at a market and start to formulate a trade idea. And this will be quite a generalized one. I don't want to go into a huge amount of detail about each part of the analysis we use or a screen shows, because they themselves can take up hours and hours. Each part you can talk about for hours. The indicators, the actual chart itself, whether it's a line chart, bar chart, candlestick chart, they all have a time and a place. But I'll try and just outline what I look at to get my headset right, and it'll explain to you a little bit of maybe what type of trader I am, because as I say, I think we all have an inner trader in us, and we're all different. So I might show you something, you might see it a completely different way, because one thing I've always said is, whatever day it is, there's always at least 2 trade ideas out there. You get to the end of the day, you'll have a low and you'll have a high in the market. So at one point in the day, there was a buy trade idea which worked great, and at another point of the day there may have been a sell idea which worked great. Maybe the where I'm wrong in that is maybe when you get what's called a Marabuzzo candle, where you get it opening at the low and it rallying and closing at the high. Obviously selling it at the high last minute of the day isn't maybe a good idea, but on most days there's a time and a place to buy and sell. There's plenty of opportunities throughout the day to do loads of them if you're a real short-term day trader, a scalper or an algo or an HFT. But let me just try and see if there's any questions, just fire them in there, and I'll try and answer them as I go along. But I'd like to make it a little bit interactive. So I'll just flick to my screen, which should give you, show you a DAX chart. This is, I'm using the Saxo Trader 2 platform. We provide trade ideas for Saxo, and these trade ideas need us to produce charts, so we use the Saxo Trader 2 platform. It's pretty reliable, pretty robust, and it's got a lot of instruments on it. I think there's about 25,000 different things you can trade, which may be a bit of a chore to get through 25,000 trade ideas in a day, but we will sort of stick to the major ones. So I'll basically look at DAX first, and then sort of like give you an idea what I look at, what I use. So obviously here we've got a line chart. I know this may be very basic for some of you, but it's just an idea of what we go through. I mean, this is way back then when I first started. I traded DAX back in this era, and I sort of you know, there's plenty of opportunity to make money in these days. And you know, if only, you know, the sort of screen-based trading, sorry, the open outcry trading was still going here, I think you know, there'd be a lot of people saying, wow, that would really create great opportunity. I mean, there was good opportunity back here in these small ranges. Obviously, a line chart, just to clarify everything, just shows you the close on a daily basis. So it gives you a good indication, especially on long-term charts, you know, what the sort of what the trend is, where the highs and lows, roughly where they are. And it is quite important information if you're looking at you know, if you're analysing the markets from a technical perspective. So you know, you've got different participants, and really we appeal to the short-term traders. But again, we do get bank and hedge funds. Sometimes they dip their toe into the day trading, or they just like to have a little bit of a confidence in what they believe. So sometimes they'll receive our calls, and they look at them and I think, yeah, for whatever reason they may be bullish, bearish, whatever on the DAX. And if they get a call from us on the day to buy it, they may be sitting there thinking, what should I do? What am I doing with my long-term position? The short-term guys are still buying it. I'm happy with that. You know, sometimes they'll ask us to do some medium-term calls, so we'll do that. And it's basically just a difference between what chart you look at: weekly, daily, hourly, 4-hourly, half-hourly. So that's basically, you know, the time frames, the different time frames there are, means there's different participants in the market. The pension funds, the hedge funds, they won't be necessarily trading day to day, like the algos or the day traders, swing traders. So it's quite important to sort of, like, you know, make sure that you sort of stay focused on what you're doing. You know, it's okay to sit here and say, oh, the DAX is bullish, the DAX is bearish, and you know, you may be right over a certain time frame, but if you don't you know, get it right for the time frame you're trading, what's the point in saying, yeah, I've got it right, but I was 3 weeks too late in shorting it? It's no good. You've got to make sure that you stick to what your trading plan is. If it's you know, day trading, you've got to get out at the end of the day, you know, or you know, you don't run positions overnight. You know, you've got to know what your plan is. Make sure you stick to it. Make sure you stay disciplined, and you know, and be confident with it. You know, just because it doesn't work for a few days or a few weeks even, you know, make sure you sort of, like, you build into your trading plan the facility where, you know, if you have a run of like 4 or 5 days of losses, it's not going to, you know, wipe your account out. Basic advice that, you know, every good day trader should already know and understand. So here we are, we've got a line chart. Now that's great for long-term charts, and from this long-term chart I can see, you know, 2007 dip, in 2008, 2009 crisis, rally back, and all of a sudden 2013 we're back above the levels, the highs, and we're pushing higher. And you can see even straight away what I can, on here, a basic line chart, you can draw a resistance line. That's a resistance line while the market's below it. Again, the resistance came in here. That was a high, which obviously it got to that point. This is the 2000 dot-com bubble. Market sold off from there. They rallied again, 2007, 2008, the banking crisis. Sold off again from there, but funny enough, found support a bit higher than the lows of 2002. And we started to build a bit of confidence into 2012, 13. It broke this resistance level here. And since then, it's been pretty much one-way traffic until early 2015. And we've had a decent retracement, and that sort of pretty much shows us where we are to date. Now that's great to look on a long-term chart. So long-term, it's still in an uptrend. It's still going up. But then we look at the other support levels that we should really be considering, especially when the markets are having a bit of a turnaround, and everyone, you know, would like to sell the top of the market or buy the bottom of the market, and it's not an easy thing to do, and it's not necessarily, you know, the only way to make money. You can trade thousands of times in this time period and make decent money, and that's what, you know, day trading is all about. So from this chart here, we have the sort of like decent support, decent resistance, which turned into support around here. We had a probe lower in September, and markets have reacted higher from there. So let's take this down to the daily chart. And now what I've done is, obviously I've changed from a line chart to a candle chart. I like the candlestick charts. They again, there's a whole host of things we can talk about on candlestick charts, but I'll sort of stay away from the technicalities of it. Just to say that it can be a good indication of not just where the prices have closed, but also where the high of the day has been, where the low of the day have been, and how the markets, where the open has been, where the close has been, and sort of how that affects the market on a shorter term basis. So we look at this, and we see the sell-off that we were talking about in 2015, from April all the way down to September, and we've had the rally now. So again, we can look at support and resistance on a shorter term basis. So let's just get the obvious ones. Let's bring it across to here. Again, if we flick back to there, they're all coming in around about these levels here. This is the probe lower, and as we see from this chart, which we couldn't see necessarily from this chart, actually probe lower twice here. So this would be a formation which, if you're a technical analyst, you maybe call a double bottom. So and from here we've seen the reaction higher. I'll discuss the double bottom a little bit in detail, but not too much. And also along with obvious horizontal resistance that we face, which is there are levels at which there's once, you know, more than maybe at least 3 times you get a high or a low, then it's a good place to draw a horizontal or support or resistance line. Also, we have trend lines as well, which are quite key. Trend lines are, again, I could spend another day talking about that, but I won't. But this isn't a bad trend line here, which we see we're close to approaching. So, you know, from a live trading perspective, there's a big question mark over what the market will do when it gets here. It should find clear resistance. However, there's other things to take into account. You just don't take one component into account. You sort of like try and bring in as many tools into your toolbox as you can, and look at different things, and, you know, don't just get stuck into one thing. You've got to like be adaptable, you know, even on a sort of like daily short-term basis. But that's quite a decent trend line we're looking at here. But reaction as well from here, from this double bottom, which I said I'd come back to. So a double bottom basically is formed by 2 lows in a chart, 2 significant lows. But you can only call it a double bottom when it basically breaks back above the peak in between them 2 bottoms. Or if the chart was the other way around, it'd be the dip in between the two highs. So the good thing about formations is that some formations and some patterns can give you a predicted target. Now this is based on, you know, how analysts look at markets, how our chartist looks at a market, because we can sort of like, you know, we can talk about technical analysis and chart analysts. So technical analysts examine price action of financial markets instead of maybe fundamental analysts who would look at the fundamentals. And you know, technicians believe that all the relevant information of a particular product is in the price. And we sort of also we believe that, you know, prices over time, patterns, trends, momentum, they all repeat themselves, not exactly the same way, but in a similar way. So if we see patterns, we like to think that that pattern has a more than fair chance of replicating what it's done in the past, because everything is based on the psychology of the market, just as in the early days when it was open outcry. It's the psychology of the market. We relied on the noise and the psychology of the panic and the sort of like the, you know, the fear and the greed and everything that went on in the markets. We relied on that and to understand that, to make money. So, you know, it's all about, you know, the mood of the whole participants of the market. So you know, we're sort of we from a chart perspective, a double bottom, you could, let's measure this, we're sort of like 13% rally there from the low to there, and a break of this or a trigger of this double bottom is set to target 11,719. So that's indicating if you're trading this double bottom pattern, target is up in 11,700. Again, if you look across, you can probably get a couple of horizontal resistances, which were significant highs at the time over the last year. Let me just get my line right. And that's pretty much from this level here, that's pretty much where the resistance comes in. Now, I want to sort of, let me just take these horizontal lines off and introduce you to another indicator that analysts like to use. And I'm sure you've heard of it, Fibonacci. And so from this point, we're sort of thinking, right, chances are this is a strong rally. If it breaks this resistance here, it's already broken this resistance. We're targeting up here, a breakthrough here would see, if we look back on the chart, this little, let me get a little measure here. We see a little gap in the chart. Now that's significant. Gaps that are normally filled in charts. Normally they're filled, you know, the next day. If they're not filled the next day, they can become breakaway gaps, and it might take a longer time to fill them. So you're sort of looking at August. We're into November. It looks like it's been targeted by the markets. So a low of 11,260. Again, so this is almost sometimes act like a little bit of a magnet, but again, it's taken 3 months. So, you know, you can't just sit there long hoping for the gap to be filled when you've seen the market this far against you. It doesn't make sense. You know, it shouldn't be in a day trader's trading plan if they're looking to day trade. End of story. So yeah, that's a bit of a natural draw. This trend line, markets like to test trend lines. It's a bit of a natural draw. So yeah, looks like we're going higher. You know, so that's what you know, we want to look at. But again, I was going to say about Fibonacci. Fibonacci is a great tool. It's based again on things happening over and over again, and retracements in the market are, you know, favourite retracements are 38.2%, 61.8%, 78.6%, 50% is sometimes, you know, not as, I've never found it as reliable, but it's something to look at, something to be aware of. If you're aware of all the prices and you're watching price action, you can react to it. So have it up there, have a look, you know, and we sort of like see here the 50% retracement level has capped price action for a few days. It's broken through it. We are closing in on this trend line. 61%. Funny enough, 78.6% is not far away at all from this 11,742. So, you know, that's looks like a target, and you know, but then we sort of like got to think, right, so how do we trade that trade? Now this is how I break my trades down. I'll be looking at that, and again, we're giving it an intraday trade idea. I'm not giving you a medium-term trade idea on this. So I was trying to stick to, but then I just wanted to sort of like give you a picture of what my, I want to understand what's going on in the day before I break it down to the shorter-term timeframes. Another tool, I'm going to throw another tool in there. I'm just looking at the time, thinking it's a bit running away a little bit. Something I'd really like to use is something called the Ichimoku cloud. Again, you could spend another couple of days talking about that, but I won't. And I'll give you a brief introduction to it. Basically, the cloud is like projected support resistance levels. You can have trading. You can quite easily build a trading system around the Ichimoku cloud. And you know, it's got a lot of components which you know are very reliable components, and you know, it's a great visual tool to use to get an instant picture of short-term trend, long-term trend, whatever. So here we sort of see it broke the resistance basically around the time when it broke through this double bottom, I'll call it a neckline, and it broke above there, and it's held above it, and it's kicking on. So you know, this is like an indication that there's no more resistance. It's going to carry on going up. Or if you have a system built around Ichimoku cloud, you can class that as a buy trigger around, you know, breaking the resistance, the last resistance. You know, you sort of, when we're talking about trading systems, you don't want to rely on one tool in particular. You want to use different ones. But this one is something that I like using, and you know, it gives me this says to me, market is bullish. So what I'm going to be doing, I'm going to be looking to buy. Where can I buy it? So I don't have to redraw on these lines on the 4-hour, 30-minute chart. I'll just click down, take you down to a 4-hour chart, have a look at what they're saying. It gives you, again, the same information broken down into 4-hour. So yeah, as we speak now, we're seeing that what the last 4 hours have done, and this is like a candle I talked about earlier, a Mariposa candle, where it's opened at the low, it's closed on the high, and it's not looking like slowing down at all at the moment. So, you know, everything looks pretty straightforward, pretty good at the moment. Break it down to the hourly chart, and then we've broken the highs of the 28th, the 10,927 high, and we're holding above there at the moment. So let's take this as a, for instance, how do I formulate a daily trade idea on the back of this? So today actually was equities opened lower over the weekend. So we opened below this hourly chart here, which is an indication that maybe things aren't looking so good. It's opened lower than, 60, 70 points lower than closed on Friday. Maybe the rally's over, and there's a few levels I would look at straight away, and this is what I did this morning, and I'll show you exactly what I thought this morning. We've got obviously the daily chart. The daily chart was indicating that bullish Wednesday there. Thursday was like an inside day, bearish inside day, and a doji on the Friday. Doji is where it opens and closes the same level. And again, it's the high and low is contained within the previous day's range. So quite a neutral day. And it was pretty much the market opened a bit lower this morning. And I felt there was a danger that this level 10685, if the market was to break that level 10685 this morning, there's a danger we could reverse quite sharply, because this move higher has been very sharp and rapid and accelerated very quickly. I brought into my analysis the fact that this trend line above, until this trend line breaks, I wouldn't be getting carried away with this. You've got the double bottom, which is obviously indicating it's going here. It's not indicating how quickly it's going to get there. This could get there all the way around here. There's no sort of like guarantee in any of the, obviously, these calls, ideas, trading. Like, we all know how markets work, and sometimes it takes a long time to get up here. My concern was that a break of last week's low would lead to a move lower, and probably this Ichimoku cloud support would then sort of like come into play. So my trade call today, let me try and bring it up. No, that's not. Let me just try and bring it up on another screen and then pop it across. I don't mind admitting that my trade call today wasn't great, but I'll show you why. Okay, so this is my trade call today. Price action posted a doji candle, neutral for short-term sentiment. Posted mixed daily results for the last 5 days, which it had. There's a bit of concern. An overnight negative theme in equities has led to a lower open this morning. Price is mildly bearish today, but we need to see a break of 10,685 to confirm the downward pressure. Our profit targets will be 10.0585 and 10,500. So I was looking for the market to break 10,685. I quite often give the market a little room, because I'm looking at a specific level. Chances are I might trade that level, might trade a couple of ticks lower. But if it traded like 10 pips lower, I'll consider it may be broken. Not always, but today I had that feeling that that's where we could be going. So I was looking for to break this level, lower the day 10,728. We weren't far away from it. We didn't get really close enough. So I didn't, basically, my trade I did to sell the break wasn't triggered. Hey ho, basically I'll post a P&L of 0 today because it hasn't triggered the trade. Funny, if I had time, I'll try and flick to the FTSE chart, because I had a bit of a different attitude towards that. Yeah, so the market's broken higher. So my trade idea is nil and void. So we won't worry about it. Market's broken higher, and so if the market was to close right here, right now, my morning call tomorrow would be a lot more positive. But then again, I've still got to give an entry level, got to give a target, I've got to give you know, a stop level and get my support and resistance in. So let's draw a line under today's trading at 10,950 and say, right, Steve, it's Tuesday morning. What's your call? So here I go on to the, let's take it down to a 4-hour chart. 4-hour chart's pretty bullish. It's Marabuzzo, you know, that's what basically the daily chart would look like tomorrow. So we've got a low of 10,728, a high of 10,960. Now I'm going to show how good I am at maths and work out. No, I won't. I'll do it. I'll cheat. Right. So 50% is 10,844. Some of you might not know what I did there, but I'm sure a lot of you do. So 10,844 is basically, if we close here today, now market's closed, end of the day, 10,844 is the 50% of the range, and that was what's called a Marabuzzo level. So I like Marabuzzo levels, that they tend to work quite well. We would consider support to be around 10,844. So I'm thinking, right, trade idea today is to buy it around 10,844. Let me break it down to an hourly chart as well. I'll pop up to the daily because obviously I've got to give you a target as well. Right, let's say tomorrow's trend line resistance is 11,057. 10,844, 11,057. You know, you're looking at 200 pips as a basically a target for that 10,844 trade. Now, again, like I said in the previous few minutes, I look at a level 10,844. I wouldn't, you know, maybe I want to sort of get a little bit more than just a Marabuzzo level. I want a little bit more confidence in calling why I should be buying at 10,844. And also I've got to think about the risk side of things, because obviously the low of the day is 10,728. It's you can't, you know, if you were going to go for a slightly more longer term trade, say a 1 to 3 day trade, yeah, I'd be looking to buy at 10,844 or around that level. You know, you don't want to be too specific with levels. You know, when I trade my systems, I like to buy in front of my level. So if my level is 10,844, I'd like to sort of buy some, maybe, I don't know, maybe say wherever the range is, normal range is say 150 points. I'd like to buy some like 10% in front. So I'll buy some 15 ticks in front. So 10,860, I'll buy in front. I'll buy some there, buy some at 10,850, buy some at 10,840. So on average, I'll be long at around about the level that I consider support. If we look back here, 10,878 is the high there. Again, that's going to be a little resistance, turn support. So between 10,880 and 10,840, I want to be getting long. And if I'm looking to target a trade up to where we spoke about, back up to this 11,057 level, I'm looking at a 200-point move. My risk has got to consider what my target's going to be. If I'm, you know, if the methodology is here's my target, here's my risk, it's got to be a good risk-reward ratio, or reward-risk ratio, as we do say in that way. You know, so if we're going to risk 1 point, we're going to risk 100 points, we're going to risk 1,000 points, we want to be making at least double that, if not more. So, you know, I might, I think my trade idea as it stands tomorrow would be to buy the DAX around about 10,850. stop on that trade. You know, watching markets over the years, I always, you know, look at different characteristics of different markets. And I know that DAX has a likes to sort of trade around just above the sort of like the big figure level. I'm not letting out all my secrets today, but I'll often find that just above, it breaks a big figure level, let's say 10,900. Quite often it sort of like just breaks it. So it breaks it by 10, 15 points, and that'll flush a few stops out, and the market will come back off again. It'll just be break it enough to get a few, you know, few bulls long, thinking we've broken the big figure level, it's going to go higher, and sort of like, you know, sucker them into doing it. And the same on the downside. You sort of you tend to find it breaks through that. It gets close to that support or the big figure, the psychological support of a big figure, 10,900. It'll go down there and sort of like stall just in front of it, so people just miss out on it. You know, and then it sort of like it kicks off again. So I like the DAX around just above the 10 to 15 level, above the big figures. They're pretty reliable. I'm not going to go back and sort of like just check it. You can do that later and make a fool of me. But yeah, anyway, so I'm looking at 10,844. Sorry, 10,850 as a long. I'll put my stop below 10,800. Give it a little room, 10,790. So I've got a 60 tick stop. My target, as we said, is here, 11,057. So I would, again, I'm got to consider what the normal trade range is. So, you know, I look at ATR in most markets before I start to analyze them. So, you know, I'm going to think if this market does hit a low around 10,850, there's a good chance it's going to, you know, if that's the low, it's a good chance it's going to have a 200 tick move because it's done it a fair few days. So, you know, why not have a target 11,050, but maybe not to get too greedy. And again, think about how I look at the DAX and how quite often it just breaks that big barrier level. So it'll just break 11,000 and I'll put my offer in at 11,000 and I'll see it, maybe see it break it, maybe see it hit 11,015, come off and maybe push a little bit higher later on in the afternoon to get to that 11,050. So yeah, that's how I've looked at that as a day trade. That's how I would build a day trade. Now I've got to do, well, as a team, we do 25 to 30 day trade ideas a day. So I've got to sort of like understand where the markets are and do it a lot quicker than I've explained it to you in the last hour. Just seen a little message from Oscar about taking a look at gold. Now I had oil bit stuck in here as well, but I'll show you gold. Let's go on to, I'm sorry I haven't left enough time for questions and answers at the end, but obviously I'll try and prepare a little bit better next week and give you, you know, or the week after. I think Ian's doing next week. He's probably listening to me now saying, no, I wanted to see you suffering. Yeah, this is my first one, so I'm a little bit all over the place with it, but I'm doing my best. Right, so let's take a look at the gold. It says oil, but it's not. It's whatever it is I tell it to be. Right, so gold, again, we pretty much, I presume quite a few guys on here may understand what gold is if they trade FX. You know, they understand FX has a big influence on the gold price. It's a dollar-based commodity. And I'm sure we all remember the heady hikes back in 2011 when we sort of like getting close to that $2,000 a barrel, and then everyone was talking about $10,000. Sorry, $2,000 an ounce. Everyone was talking about $10,000 an ounce, and maybe one day, who knows. We've had the big retracement back. Obviously, we're in a bit of a bear trend. Let's get a few lines on here. I'm just pumping these in because I sort of like, we obviously analyze gold and I know roughly where they are, but I haven't got our charts up to show you. Weekly basis, this is a downward trending, but this is, although it looks like a bearish channel, it's not really. It's it can be this can be a bullish indication, bullish formation. So again, we'll talk about that another day, but let's see what it's done recently. There's a lot of talk again about breaking $1,000 bucks, and you know, there's still a chance of doing that. While we're below $1,200, I'm bearish of this. $1,200 is resistance around 1190 actually, or 1192 I think more specifically is one of ours. I think it's a Fibonacci extension level, or a Fibonacci retracement level from the move downwards. But 1192, I think that's the high back in October. So we had that as a resistance level. It was lucky enough to just hit that pretty much spot on, and it can't come off from there. Since then, weekly chart, we've had 2 bearish weeks, which has brought us right back down to start of October. But you know, looking on it, this weekly support trend line looks pretty good. 1, 2, 3, 4, 5 points of contact. I'll take it down to the daily, try and squeeze this in quickly, and let's look at 2015 to give an idea of what Fibonacci enthusiasts might be looking at. You see here 50% retracements, 1190. We've hit this low again. If we want to break this down again, it's another, sorry if I'm confusing everyone now. It's like a bearish flag formation around here, which failed, broke higher, broke back above the 11,100. Since then, this 11,100 level has held pretty well. At the moment, we're having a pullback from the 1190 level. Again, it's we've got this really nice trend line support. So on a daily basis, I think we've got a little bit more room to move further down. But as we approach this trend line, my view would change, because obviously we're trying to give a day trade. As we get close to the trend line, you're going to see some buyers come in there, because you know that's, you know, that the trend lines are used by a lot of people. You know, more sort of like medium-term traders will be looking at that and looking at this level. Let me try and bring it up exactly where it is, depending on what day it does it. 1120. I mean, I know I've got 1120 as a support level. So as it approaches there, I'd be thinking, right, let's really seriously think about whether we're going to break this support level or not. Let me take you down to a 30-minute chart and give you a quick indication of what I call today, if I can bring it up. Let's go back in here. Commodities, I was bearish of it this morning. Gold prices have continued the bearish move low and resulted in 4 consecutive negative days, trading within a corrective channel formation. The bias remains mildly bearish, but there is scope for moving in direction. A little bit of a caveat thrown in there. Preferred trade is to sell into rallies. I was looking at 1145. The day before, we were looking at, Friday, we were looking at maybe buying a break of 1150. So my stop naturally would be just above 1150. 1151 is my stop. So, but I felt it could break a if it basically breaks above 1150s, get out of it. Good chance it's going to continue higher. But in the event it doesn't, 1145 was the level to sell it at this morning. Let me just bring it down to, yeah, pretty much 8 o'clock. 11.41 the high. So it didn't trigger our short level, but it has sort of come in the direction. So, but we think like good chance that this is heading maybe towards the 11.20, 11.25 level before buyers really come back into the market. I've been asked to wrap the session up. Thank you very much for listening to my blurb this afternoon. It's been an enjoyable one, and I look forward to speaking to you all very soon. Thank you very much.